Imagine this. You've been out of college for 3 years. You've worked every overtime shift offered. You haven't missed a single student loan payment. You log in to check your balance, expecting to see a lower number, but it's actually higher than the day you graduated. It feels like you're running on a financial treadmill that's tilted at a 10% incline. You're sweating, you're exhausted, but you're stuck in the exact same spot. Enter the SAVE plan. It's been hailed as the holy grail of student loan repayment. Lower payments, no growing interest. It sounds perfect, but is it? Today on Get Money Wisdom, we're taking off the rose-colored glasses. We're breaking down why the SAVE plan might be a literal lifesaver for some, but for others, it's a mathematical trap that could lead to a massive bill from the IRS that you never saw coming.
First, let's be fair. SAVE, or Saving on a Valuable Education, is objectively the most generous repayment plan the federal government has ever created. It calculates your payment based on a much smaller slice of your income than the old plans. For millions of people, this means their monthly bill dropped by hundreds of dollars. For some, the payment is literally zero, and people love it. Why wouldn't they? It's immediate breathing room in an economy where everything from eggs to rent feels like a luxury. But here is the first loop for you to chew on. SAVE stops your balance from growing, which is great, but did you know it can also stop your debt from ever disappearing while setting you up for a bill that has nothing to do with your education? How is it possible to pay exactly what the government asks and still end up owing the IRS more than your degree actually cost? We're going to look at that math in just a second, but first, we have to understand the soul-crushing physics of debt. Normally, when you pay off a loan, it's called amortization. In the beginning, most of your money goes to interest. As the balance drops, more goes to the principal. That's how you eventually reach zero. But many of you have experienced negative amortization. That's when your required payment is, say, $100, but your interest is $150. That extra $50 gets tacked on to your balance. You pay, and yet you owe more. That's the treadmill. The SAVE plan fixes this with an interest subsidy. If your payment is $40, but your interest is $160, the government just waives the other $120. Your balance stays at $30,000. It doesn't grow. This is where the trap is set, because while your balance isn't growing, for many of you, it isn't shrinking either. You are essentially renting your debt. You're paying the government a monthly fee to keep your debt exactly where it is. You could pay for 10 years, and if your income hasn't skyrocketed, you'll still owe $30,000 in 2026. This brings us back to that question. Why does this matter if the debt eventually gets forgiven? Well, here's the second loop. There was a law that made this forgiveness tax-free, but we are now in 2026. The world has changed, and that safety net, it might have just snapped. Let's talk about the tax bomb. Under the SAVE plan, your debt is forgiven after 20 years for undergrad or 25 years for grad school. In your head, you're thinking, great, in 20 years, I'm free. But the IRS looks at it differently. In their eyes, if the government forgives $100,000 of your debt, you didn't just get a break, you just earned $100,000 in income. Let's look at the math. If you're in the 22% tax bracket and you have $100,000 forgiven, you now owe the IRS $22,000. And here's the kicker. The IRS doesn't do 20-year repayment plans. That $22,000 is due on tax day. All of it. Now, some of you might be thinking, wait, wasn't there a law against that? Yes, the American Rescue Plan made forgiveness tax-free, but that provision expired on December 31st, 2025. As we sit here in 2026, unless Congress has stepped in with a last-minute extension, that tax bomb is officially live again. You might be trading a student loan payment you can't afford today for a tax bill you definitely won't be able to afford in 2 decades. This is the reality of the SAVE plan. It's not a delete button for your debt, it's a delay in convert button. It converts student loan debt into IRS debt. So is it all doom and gloom? No, but you need to know which bucket you fall into. Bucket 1, the green light.
If you're going for public service loan forgiveness, SAVE is your best friend. PSLF forgiveness is 100% tax-free under current law. If you work for a nonprofit or the government, stay on SAVE. Bucket 2, the strategic choice. If you have $200,000 in debt and earn $50,000, you'll never pay it off. SAVE is your only option. Your job isn't to pay off the loan, it's to start a tax bomb sinking fund. Put $100 a month into a high-yield savings account now so you can pay the IRS in 20 years. Bucket 3, the danger zone. If you have a manageable amount of debt, say $30,000 and a decent job, SAVE might be a trap. It encourages you to pay the minimum and stay in debt for 20 years. You'll end up paying more in the long run and facing that tax bill. You're better off attacking the principal now. Don't let affordable become eternal. The SAVE plan is a tool, not a solution. Your next step? Go to studentaid.gov and use the loan simulator. Use your real numbers. See what your balance looks like in 20 years on SAVE versus the standard plan. If this breakdown helped you see through the fog, hit that subscribe button. We're here to help you navigate this 2026 financial landscape without getting burned. Drop a comment below. What's your current student loan horror story? I'm reading and replying to as many as I can. Get money wisdom. Let's get your money working for you, not against you.